Good afternoon, everyone. I'm sorry for delayed start. We have a lot of attendees who had, started committed to start at maximum. We will start within 1 minute. I appreciate everyone joining this afternoon, spending your important family time with us to understand some of the most important topics that everyone is thinking about today, and they would like to understand that what is happening and where does it stands overall and how it impacts them. So our today's goal is to discuss about some of those exciting things. My name is Sam Tucker. I'm Group CEO of Perfect Group of Companies. And our goal today is to discuss some of the very interesting topics which, are most relevant in today's market space. And everyone would like to understand how it impacts them and what is the best way they can plan for that. So let me get started. I'm going to share my screen. We have a lot of topic to cover. So again, I'll try to keep it summarized. But anyone who has questions through this webinar, at the top of your screen, you should see a Q&A window and a chat window. You can either ask a question in Q&A section or chat section. And also in the middle of the poll, I would be technically asking, a poll question, which is very helpful for us to understand that how we can work together on this thing. So please help us with the poll question as well. And let us get started. Again, one more thing that this tax planning and smart investment is part of our intellectual property. So recording and photography of this session is strictly prohibited. So if you need any of these questions or if you need a copy of the presentation would be posted on our website. But please don't try to, because some of the strategies are complicated strategies, and if not properly understood, they could be hurting than advantaging. This is recently the picture of one of the development which we are working on 121 in Alma, and it's just a model picture of what we are developing over there. Perfect Group started business. A little bit, background about us, who we are, where did we start, and what is the status of our company. So Perfect Group originally started business in 2002, and Perfect Group has been named as one of the fastest growing small business by US Chamber of Commerce and Inc. 5000 magazine in 2020 and 2016. So we were named, branded as one of the fastest privately held growing company out of top privately held 5,000 company in US. Our group expertise lies in tax planning, risk management, real estate development, media, hospitality, and entertainment industry. Just to give you a little bit of an idea, Perfect Group of Business is divided its business into three different umbrellas: media, entertainment, and hospitality, which includes the radio channels, which you all might be familiar with, Phonesia Radio in US. We also have other radio channels outside US, which work under different brands. Digital media, theater, food and entertainment, concerts and events. Real estate, we do residential development, mixed use commercial, land development under Tucker Developers brand. And tax, finance, and real estate consulting, we do federal returns, real estate incentive planning, high net worth HNI corporate tax planning, and CFO services. On the right side, you see Perfect Group of Company today exceeds $25 million in annual revenue with a CAGR growth of 43.12% for last more than 12 years. So our year-over-year growth has exceeded more than 43.12% as a Perfect Group of business companies. As a radio venture and radio business, we are world's largest South Asian radio network, excluding India, in two large markets in USA and UAE, which makes up for about majority South Asian NRIs living outside India. In USA, we own 104.9 HD1, HD2, HD3, HD4, 95.5 FM, and 1110 AM, which you hear our popular broadcasting with. In UAE, our group also owns three other channels called 106.2 Big FM in Dubai, which was recently acquired in January 2020 from Z TV Group, and Beat FM and Love FM, which were also recently acquired in June 2020. And we are now the #1 privately held radio network in UAE as well, not only in South Asian space, but overall as a radio network. We also operate as HD radio streamings, and last year we provided live streaming with over 10 million hours of digital streaming content streamed digitally. We are also operating 9 digital music channels globally. This is our corporate group advisory board. I'm Sam Tucker, Group CEO. I introduced myself. Vaishali Tucker, who is CEO of Perfect Tax and CEO of Finasia. Mahesh Tucker, who is Chairman. Purvesh Tucker, who is CEO of Taka Developers. Sam Sayani, who works as President of Taka Developers. Dheeraj Kapuria, who is CEO of COO of Finasia Media Group. Devas Dungal, who is Director of Perfect Tax. David Pagan, who is also Director of Tucker Developers and Legal Counsel. Nick Smith, who is our Legal Counsel. And Mohammed Qasim, who is our advisor. So our predominant business model is we create innovative products, keeping customer value proposition in mind, making sure that they're compliant, and making sure that they add value to our customers. If you were to divide overall capital wealth in the US, how is that capital wealth divided over? If you really see, $27 trillion of wealth is in real estate, $13 trillion of wealth is in bonds, cash and equivalent is about $9 trillion, and stocks are about $15 trillion. A little bit about me, Perfect Group CEO. I act as a Perfect Group CEO and CEO for International Radio Channel and Network. My specialty lies in tax and accounting, real estate development, financial services, and media and entertainment. I have an accounting and business degree from UTD, over 20 years experience working for Fortune 500 companies, including Microsoft, Capital One, and multiple other Fortune 500 companies like Verizon. So today's topic are very interesting. Again, people who have recently joined. My name is Sam Tucker. Please use your Q&A section to ask questions or chat window to ask questions. And I will be keeping on answering those questions throughout the webinar. You are also possibly listening to us on Facebook Live. We have Vidya who is moderating Facebook Live platform. So if you are watching us on Facebook Live, do make sure that you ask questions on that as well and on the comment section. So if you really see this here, tax on real estate investment income currently, and there is a 3.8% net investment income tax, which we also call Affordable Care Act tax or Obamacare tax. So current capital gains tax rate, as we speak, is 0% for incomes up to $80,000. For short-term gain rate is 10 to 12% up to $80,000. Long-term capital gains tax rate from $80,000 to $496,000 income is 15%. For short-term capital gains rate is 22 to 35%, which is normally like an ordinary tax rate. So whatever your ordinary tax rate is, if you're selling something short-term, you pay the same exact ordinary tax rate. Plus you pay 3.8% net investment income tax, as the slide shows. Long-term capital gains tax rate is 20% if your income is 496 or more, and short-term capital gains tax rate is 37%. Well, currently the candidate, if Trump wins, the current rates would continue. I don't think there is any plan to make any significant changes there. But if Democrats win, Joe Biden has promised to change the tax rates a little bit. The first 3 slab rates stay as it is, or actually 2. The third one, instead of 37% tax slab rate, that increases to 39.6%. And even long-term capital gains tax rate, if you're making income of $1 million, you are going to pay 39.6% flat capital gains tax rate. So the topmost tax rate is going to go to 39.6%, almost 40% plus 3.8% net investment income tax. So a lot of people ask me, how important is tax as far as, impact on investment is considered? And I said, let me do an illustration that gives you a little bit of an idea that how important is tax rate. If your money was to grow at 12% return and double every 5 years, how would it have an impact if you were to pay taxes versus not pay taxes? This is an illustration, an example. If somebody invested $100,000 today and the average person's tax bracket is in 30%, if that money is growing tax-free, then in 30 years, you would have $6.4 million. In 25 years, it would be 3.2. In 20 years, it would be 1.6. In 15 years, it would be $800,000. But if you were to pay tax every time and double your money every 5 years, which is at about 12 to 14% interest rate, you are talking about, half of that value. So if you were to pay tax every time and the leftover money is again double, then instead of becoming tax efficient, if you were to pay taxes every transaction or every sale or exit transaction, then you would only be left with $2.4 million versus if you grew it tax free, you're talking about $6.4 million. It could be a very, very powerful impact. So a lot of people also ask me this question that can you, at the end of 30 years, do you still pay, or whenever you retire, do you still pay that tax on $6.4 million? You can design that way that you pay zero tax eventually. So tax-free growth could be an extreme powerful tool in any kind of investing. So if you're investing in stocks, bonds, mutual funds, real estate, it doesn't matter what form of investment you do, tax efficiency, and this is, I'm not even talking about short term. So people who are day trading, people who are trading, buying and selling stocks in the stock market, your short-term gains could have a very, very significant impact, maybe even twice than theirs, or one-fourth. You might be only left with one-fourth amount of money if you were paying all short-term gains. So how to make your investment tax efficient? This is the question a lot of people ask me, and also ask Vishali as a CEO of Perfect Tax. But there are four major categories today available, and under each of these categories, they're complicated vehicles. You can do many, many things under this category. A 1031 exchange. Now, 1031 exchange, a lot of people don't understand. They feel it's a straightforward thing. 1031 exchange, as everyone knows, it's a very simple thing where proceeds of your principal plus the gains, you roll it out into a 1031 exchange, and you get about 40 days to decide the property, 90 days to complete the property, and 180 days to close on that asset. And you can do a 1031 exchange, but that is mostly for real estate. You cannot do that for stocks or bonds. You can also, 1031 exchange could again get very complicated. We have a few slides on 1031 exchange where we discuss about that. Donor advised fund is also very interesting, where you can technically, you don't know where you want to donate the money while you die. You can put money and fund into donor advised fund and leverage it such a way that you still walk away with more money in your pocket, your family walks away with more money in your pocket, and by getting the tax deduction, and the money grows tax efficiently and tax free into the donor advised fund, which again could be invested into stocks, mutual fund, bonds, real estate, or a variety of assets. Charitable strategies. There are more than 50 different kinds of trust and charitable strategies. Example, CRT, Charitable Remainder Trust, which is a phenomenal vehicle where you can create an annuity of the income. So example, you donate or you contribute a low cost basis, high capital gains asset, and eventually that asset grows tax free, and eventually you can take that income out of that CRT trust tax efficiently or deferred, and eventually there is a small portion of money that gets donated, which again can replace that, leveraging a life insurance vehicle through your tax savings. Fourth thing is investing into opportunity zone. I think a couple of years back, opportunity zones were rolled out. I think it was in 2017 or that, where the focus of opportunity zone was where you don't have to reinvest your principal, which you have, which you generate capital gains. And this was applicable for any kinds of asset, be it stocks, bonds, mutual funds, real estate. Doesn't matter what kind of asset it is. You can technically save money by reinvesting only your gains in opportunity zone. Not only that, further growth could become tax-free as well if you do it correctly. Cost segregation is another way where when you own a real estate asset transaction, you can do a cost segregation. Example, an asset could be separated, into, so if you own a real estate, you can separate air conditioning valuation to your brick and, wall valuation, to your wood, to electricals, to, other things. And each of those assets, once segregated, could be depreciated at an accelerated pace. Example, air conditioning, electronics might get depreciated over 15 years versus normal assets are depreciated, or real estate assets are depreciated over 25 to 30 years, 35 years. 1031 exchange. What is 1031 exchange? I think we have a question on the screen. Let me see if I can add, take that question. So how is your real estate investment offer better than traditional REIT funds that offer dividends from day one, such as VNQ with GLSX and AJNC? So we'll talk about that. We have phenomenal, things which your real estate investment. We have not yet to real estate investment. I'm just right now talking about, what kind of investments are there and what kind of tax efficiencies you can create and how we can help. So right now, focus in the first part of the presentation is just talking about the tax efficiency, and the investment and how you can do this thing. So we would cover more into detail about the real estate investment also in the later slides as we go through this presentation. Switch to the presentation. That's a good question. So 1031 exchange is 1031. It's under section code of 1031 for Internal Revenue Service Code, and it provides no gains or loss will be recognized on the exchange of property held for productive use in a trade or a business or for investment. Benefits: you get an immediate tax avoidance, you get time value of deferral, you avoid higher income tax bracket and new 3.8% Medicare tax. You preserve personal exemption and stay out of piece tax. You get greater buying power. Your increased return on investment. Less management and consolidation. You get fresh depreciation schedule. You create new cash flow. You get diversification of assets. You get relocation or expansion of business. You get future conversion to primary residence or vacation home if you decide to. It depends on the kind of asset you invest into. Your possible elimination of capital gains or gains, and estate preservation with stepped up basis. So there are lots of benefit of 1031 exchange if done correctly. This is just an example of somebody doing a 1031 exchange of a sale price with the capital gains, Medicare tax, depreciation recapture, federal tax liability. Your net proceeds are going to be about $415,000 if your sale price was $500,000. Versus if you are doing 1031 exchange, you are buying directly $500,000. Your buying power in the first one is $1.38 million. So you can buy $1.38 million asset versus your buying power with a 30% down is a $1.6 million asset. So your rate of return is directly related to your buying power. Again, my initial part of the presentation would be on a lot of concepts and a lot of ideas how to use that. My later part of the presentation would focus on what we can do, what options we provide, how you can invest with us, and what could be your advantage. 1031 versus sale immediately avoids $84,500 in federal tax liability. You are able to invest all the proceeds. You leverage extra $84,500. You're acquiring new property worth $281,000 more than you could have if you paid the taxes. You collect higher rents from day one. More depreciation is available, and you enjoy greater appreciation long term. So that's why tax efficiency is a very important topic. How does charitable and gift annuity work, or CRT works? Donor transfers cash, security, or other properties to charity or CRT. Donor receives an income tax deduction and may save capital gains tax. So charity pays a fixed amount each year to donor or to anyone donor names for life. Typically, a portion of this payment is tax-free. So when the gift annuity ends, its remaining principal passes to charity. So gift of an appreciated asset, your fair market value deduction up to 30% of AGI. So if you are technically, gifting an appreciated asset, because that asset has control, you can directly deduct a fair market value deduction of 30% of AGI. You avoid capital gains tax. You creatively use with closely held stocks. Your donor holds publicly traded stock with fair market valuation of $100,000, which you could have purchased for $10,000. So benefit of contribution of stock is you avoid capital gains tax on $90,000 on the amount. So basis of charitable remainder trust, CRTs are irrevocable trusts that provide for and maintain two sets of beneficiaries, where you receive income during your lifetime, and you can design it such a way that it is you and your beneficiaries, which is your spouse or your kids, and later on after your kids die, the residual money goes to the maybe some kind of a charity, which again from the tax saving, if you were to do correctly, you can replace that vehicle with the life insurance policy, so no pocket goes from your pocket out of the cost to the charity. Income beneficiaries, donor, and if married, a spouse. So you can also have income beneficiaries not only during your lifetime, but also during your beneficiary's lifetime. So the basic objective in doing this, something like this, is retain income and gift to family for life, benefit charity at the death with significant tax benefits. What are the CRT benefits? Donor maintains control. So you as a donor are maintaining the control over the asset. Donor draws an income / cash flow during donor's lifetime. So while you're alive, you are taking income out of this trust throughout your life, and you're not paying taxes today, capital gains tax today. And this is applicable to stocks, bonds, mutual funds, any kind of capital gains tax. And you can also there's one question that yes, will you be sharing different ideas on the investment? Yes, I will be sharing a lot of ideas on investment. How does 1031 exchange apply to real estate investments in India? So 1031 exchange could be done in India or US. There are specific, companies who have to hold the proceeds of your, capital gains transaction. But if you do it correctly, yes, you can technically achieve a 1031 exchange for assets lying internationally as well. It's not necessary that you have to have all the asset in US. So is tax-free investment a 401k? No, tax-free investment is not a 401k. We are talking about, doing such a way where you're growing your asset and eventually you're rolling out the asset into, CRT kind of a vehicle. And again, there is multiple vehicles similar to CRT. There are about 40 different kinds of trust which you can utilize, and you can, make sure that you save money. So if you have close to $1 million in capital gains, I think there's another question that if someone has a close to $1 million in capital gains, is there a way that you can avoid paying tax at once? Can I spread the tax liability, please? So yes, you can do that using any of the strategies. Depends if it is real estate, you can use 1031 exchange. But if not, it is not a real estate, you can comfortably utilize strategies of CRTs and trust to technically defer paying tax or avoid tax and make it efficient also, and extend this throughout the life. Will you be sharing the PowerPoint audience for your review leisurely? Yes. So we will be sharing the PowerPoint eventually as well, so where you can review it. In the Q&A section or a polling section, please mention your name and email address. And anybody who is mentioning the name and email address in the poll section, which I'm going to release at the middle of the presentation, we'll be sending the presentation to them. So whoever is answering the poll, we will make sure that we share the presentation to them. So legacy to charity, the CRT benefits are that you get a cash flow. And I think this comes back to the same question, that you would avoid paying zero capital gains tax today by using this, charitable remainder trust benefits. You would be able to draw an income and make and derive cash flow through your lifetime. Not only through your lifetime, you can design it such a way that it could be also your spouse or your beneficiary's lifetime. And towards after your beneficiary's death, maybe the residual money goes to charity, and you are able to deduct on that money today. So you still get the tax benefit today. You also get increased cash flow from unproductive assets. So you get an immediate income tax reduction of present value of remainder in trust. So let's say your present value of remainder in trust is 20%, then you would get an immediate deduction on your other income, which would save you additional taxes on your other income. Not only saving capital gains tax here, but we are talking about saving additional tax from your ordinary income. You can technically get an additional deduction on top of saving capital gains here. And you are also removing your asset from estate tax deductions or estate tax taxabilities. So it has multiple benefits. CRT example, If a donor is age 76 and spouse is age 72, amount of funding was $200,000 in security, your cost basis was $100,000. So let's say we are assuming a return of 5% here. So in this scenario, your annuity payment to donors for rest of the life would be $10,000 using an AFR of 4.6%. So charitable income tax deduction, $94,546 in annuity trust, saving you $33,000 in taxes today. You're avoidance of capital gains tax of $20,000 on sale of security because your capital gains was $100,000 on a stock of $100,000. So now you have saved capital gains tax of $20,000 and you saved federal tax of $33,250. You have an estate tax savings in surviving spouse of $100,000 at a 50% rate. So if you really compare, your total tax savings or benefit is, including estate tax, is $153,000 in your benefit. This is a phenomenal benefit by using the charitable trust strategy. This is not only saving you what you were supposed to not pay in capital gains, it's saving you more than that. Advantage of real estate, and now I'm going to a little bit flexibly go into another important topic of today's presentation, but there are many more strategies. Again, in order to keep this session precise and also give you ideas, I'm trying to cover a lot of material in a short amount of time. So my strong recommendation is, if anyone has any questions about some of that slide, my recommendation is just note down your slide number and title, or the name, and then send an email to info@perfecttax.com or salesteam@perfecttax.com, or you can also give them a call at 469-213-1519. Again, you can give them a call at 469-213-1519, or you can text me at 214-454-7230. Again, you can text me at 214-454-7230 if you have any questions about this presentation. We have more than 60 people attending this presentation today. I appreciate everyone joining. Again, whoever is late joined, my name is Sam Thakkar. I'm Group CEO, Perfect Group of Companies, which includes Perfect Tax, FunAsia, and multiple other brands, Fun Movie Grill and Fun Pizza Kitchen as well, and Thakkar Developers. Our goal today is, the first part was on the tax benefits, how you can derive tax benefit and capital gain tax benefits, and what are the strategies you can do. And our next we are getting into is, how do you invest? What can you do to invest? What is the different kinds of investment options available? And at Thakkar Developers, what do we offer to help you invest? So advantage of real estate and rent generating and investments. So one thing I always say, that everybody has got to live and work somewhere. So real estate is not going anywhere. Population is increasing. Everyone is going to live somewhere. You'd be surprised that in Dallas, even in the worst market, there are 15,000 multifamily units consumed every year, because people are coming, more and more people grow. They're born, they grow, and then they get into job market, and eventually they're looking for an apartment or a home. Again, another important thing I also tell people is, manufacturing of new land has stopped. We have a finite supply of real estate or amount of real estate in any part of town. Again, there is history of year-to-year appreciation from more than 100 years. There is tax benefits. If you do it correctly, you can pay zero tax on these assets. You control it more than stocks and bonds. Outcome-wise, you control more than stocks and bonds. You normally already understand most of the mechanics of the process. When you invested in your first residential home or your own primary home, you have already done to some degrees of this investment anyway. Your ability to negotiate price and terms as well. Disadvantage of real estate investing is time consuming. If you own a house, you would have to do plumbing calls in the middle of the night if in case there is a plumbing failure or electric failure or anything. There are liabilities coming from them. It's a 24/7 job. It's stressful. Lots of money is involved. You have to technically, if you were to buy a house or an asset yourself, if you want to buy a good asset, you are going to have minimum $500,000 in investment, even if it is a single family home. It's not liquid, and there are commissions and fees that you have to pay. So that is a disadvantage of real estate. But one unique advantage, which no other asset gives, actually in stocks, you can do a little bit of that, but mostly in real estate, you can do the highest amount of leveraging. So what can you leverage? Let's understand that. You can leverage money, you can leverage rents, you can leverage net worth, you can leverage reputation, you can leverage time, you can leverage your network, you can leverage information. Real estate is a combination of all of these things together. It is not combination of one thing. Actually, there is one more question. This seems focused toward high net worth individual. In this session, useful for someone with a total household of 150K with a single primary earner. So this particularly is designed for real estate investing and investing and avoiding capital gains taxes. This ordinary tax planning strategies are scheduled for next week on Saturday at the same time. That how somebody could technically do tax planning for somebody at an income level of $100,000 or more. But today I'm going to talk more about investment, real estate. Does contribution to trust in India qualify for CRT benefits? Yes, you can. You can contribute. Trust in India, the trust has to be created in US, but assets or capital gains could be leveraged from India as well. So how do you compare real estate to REIT investing? So I'll cover that in a few minutes. The upside on real estate investment is quite different than REIT. You can leverage a real estate investment, but you cannot leverage a REIT. So what that really means is that, if you were to invest, if your real estate was performing 10% return per year, then you can technically put down 30% and make 10% on your equity. And not only that, you can borrow money at a 3 to 4% interest rate today and make 6% more on that asset as well. So you can make on banks' money 6% per year, and on your own money, you can make 10% per year. And if you combine that together, your total rate of returns could exceed 15 to 20% also if you were to do real estate, versus if you were to do purely REIT. REIT is only equity. So you can only make 6 to 8%, 10% on your invested money. You would never be able to generate a double-digit rate of return using REIT unless and until it is an aggressive REIT and it is investing into Class B, Class C, Class D assets. So there's one more question I would like to take, and then I'll continue the next part. How is COVID going to affect the commercial real estate? Nowadays, all office and companies are adopting different strategies. They're working remotely. How these numbers you are showing or will impact? So I will answer that question subsequent to this slide presentation, and I'll walk you through this thing. So we'll talk about that in a few minutes. So income property, rent leverage. This you cannot do in REIT. Income property is valued based on revenue, not just real estate. So typical apartment deal, example, valued at 6 times gross rents. Example, 20 units at $416 per month, giving $100,000 revenue, value is $600,000. 10% rent raise to $458 per month, increases to $110,000. New value is now $660,000. So if you were to increase your annual rents by 10%, then your valuation increase also happens same way. Net worth leverage. How do you leverage net worth? That's a very important topic. Higher net worth equals to more business respect, better business terms, more opportunities. So higher your net worth, your banks would finance you at a better rates, and your banks would technically, also finance you at a better leverage rates. Instead of 70-30, instead of you bringing in 30% equity, 70% leverage, you can technically try to get 80-20, 10-90, depends on the asset. Network for most part is stated. Very seldom do you need to get appraisals to back it up. Reputation leverage, do more deals, so becomes more of a known factor. So see net worth leverage, past performance leverage, leverage with banking. So if your reputation, if you have been doing multiple deals together, again helps with your financing and debt financing. Bank technically look at your past performance and are able to give you a better leverage and better interest rate based on your reputation leverage. You're leveraging your reputation of doing multiple deals and past entry and exit both. Time leverage. What is the only thing that is 100% finite and always in limited supply? Time. So get other people working for you. Referrals, leads, employees, tenants, brokers, loan brokers, lenders. In REIT, you're not actually accomplishing that. That benefit is taken by REIT. You are actually only leveraging your equity versus if you were to do and start your own real estate business or invest into real estate network, then you are technically leveraging your referrals, leads, employees, tenants, brokers, loan brokers, lenders. I had one client who started investing into rental homes, and he had one home. Today he owns over 180 homes. So it's very, very important. Develop systems to do deals efficiently and quickly. Warren Buffett always says that whenever you're investing, don't try to get the most optimal number or lowest cost value. Reason is find out what was the initial reason why you went into this deal. What was your analysis in this deal? What time duration you're given to yourself to exit and enter into this deal? Don't waste your own time. Don't let others waste your time. That is very important. Deal with professionals. Don't try to do everything yourself, even though you have to share. So Warren Buffett clearly said that when you technically are, doing a deal, make sure that, you're not, wasting your time technically working, and leveraging your time at the best supply, because time is one thing which is always limited and, finite. Seller-centric buying. Deal doesn't come down without both a buyer and a seller. So both parties have to be satisfied. Seller has inertia on his side. Find out what the seller wants and give him the minimum you can to make him happy. So buying, I always say that a lot of times your profit is not made at the exit, but it is made at when you buy. So if you buy correctly at the best minimum effective rate, you can technically get the optimal profits at the exit transaction or sell transaction. Leverage, typical leverage which I've seen today at local banks with good credit is 20% down, local banks, good local credit, local history. 25% down at more conservative lenders or on more borderline deals, and 30% down at some lenders who may allow a seller finance second lien also. Seller financing, seller almost always wants the cash. So cash talks. You can get a better price if you have all cash. But sellers, listen, most of the time sellers know the real value of their building. They'd be really happy to show you how the rents will increase 50%, but they're not stupid enough to base the value of their second lien note on its projections. So when the money is easy, seller financing is very hard. When money is tight, seller financing is more likely. So in the current market, you can find more seller financing deal. If I can't start with zero cash, how do I start? So if you don't have good credit on you, or you don't have money or assets for a down payment, you'll need to work on these problems first. So build up your credit rating, save up a war chest of minimum amount. Typical investment deals, make it part of the group or make it part of individual. You have to have minimum $50,000 to invest into some of these deals. You can invest it from your 401k portfolio, your IRA portfolio, your retirement portfolio, but you're talking about minimum $50,000, should be available for you to invest. Own your home first. Start making contacts. Keep watching for the rare, but sometimes attainable zero low deal, down deal, but don't build your future plans on being able to find it. If you find it, great. If you don't find it, don't bank on those deals. Other people money, that is very, very important. What do I mean by that? Purchase money, improvement money, grants, hard money, tax incentives, credit cards, and construction money. So whenever at Thakkar Developers, when we invest, we always are looking at all of these 7 items. We put our equity down, we get sellers improvement money if it is available. We apply for all kinds of grants. We find the the mezzanine money. We get the tax incentives. We get the credit card and construction money. So we find also the city incentives as well. Money sources. What are the normal money sources? Lenders, sellers, partners, government, tenants, buyers, family and friends, retirement money, credit cards, and home equity. You'll be surprised that we have in our Alma project, which was a project that was launched in 2017, end of 2017, we today have been able to achieve more than $15 million in cash incentive from city. On a previous project, which we just exited out, which was a Marriott project, we had a $23 million incentives from city as well. So money source was important because you need to find out where your money source is. Taxation. Understanding real estate taxation is key to the entire process. As I told you and as I showed you earlier in the initial part of the session, that if you were to understand the taxation correctly, you can save a lot of money in real estate taxes. Ad valorem taxes are property tax. They are negotiable. Don't tax increase lying down. So whenever you invest into assets or real estate, you can negotiate on your property tax every year. Income tax are partially settled by interest and depreciation deductions or 1031 exchanges. Capital gains tax are due on sales profits. But again, I think I told you initially, we can avoid that by using the CRTs or schedule planning strategies. You recapture taxes are due in year of sale and are high at 25%. Understand your 1031 exchanges also. I think I mentioned that to you. Locating your income property, it's very hard to understand how do you find an income property. Do your homework. Pre-qualify with lenders first. Have your down payment lined up. Quantify with an acceptable deal looks like in your mind. Join network investing. So we bring you network investing. So instead, if you don't want to do it alone, and if you don't feel that you have enough capital available, then network investing is very interesting, where you technically join our network and we are investing together and you're leveraging that, giving you a much higher rate of return compared to doing it yourself. So we have network of investing at Perfect Group of Companies. At Taco Developers, we have network investing where you can come in together and we will connect you to this network and we pull group of investors together. We ourselves invest, we help you manage it and implement it and maximize your returns on that. Identify and concentrate on your market. Don't go anywhere and everywhere. Understand, go on to markets which you understand. Track financial news and trends. Very, very important. How do you value the real estate deals? I have two more questions. Let me see what those questions are. Sam, I'm interested in doing the cash flow. So I have the later part towards the end of the presentation. We have multiple slides on how to generate cash flow. Please stick to this thing and I will be discussing that. There is one more question. Let me see. One second. So IRA works, but the profit goes back to IRA, right? Jaitirth is asking a question that yes, you can invest from IRA or 401k. Even your current 401k you can use to invest, but what you would have to do is you would have to create a self-directed IRA and roll out your money from the 401k or IRA and invest from there, which is tax-free and tax efficient. And if you were to withdraw any money recently in the CARES Act as part of the COVID situation, there is a special stimulus created where you are able to withdraw the money without paying taxes, and the tax impact will be divided over 3 years. Instead of paying tax all right now, you'd pay tax in 2020, 2021, 2022. So you can do a withdrawal also. And if you were to do it today, you can avoid the 10% penalty. But you don't have to take money out to invest. As I told you, you can keep money into IRA or 401k and we can help you, take that money out. So please talk to us, to see how we can do that. And please email to info@perfectx.com or text me at 214-454-7230 and I can answer that for you. Own home first. Is it worth it to pay off a 3.5% mortgage in order to invest elsewhere? There are two schools of thought here. There's one school of thought is that if you are confident and the investment where you are investing is not speculative in nature, like stocks, If it is backed by another real estate, then it is as good as investing into another real estate. And I will not pay my mortgage, and I would rather focus on, investing that money somewhere else. Again, the question was, own home first. So should I pay off a 3.5% mortgage in order to invest elsewhere? Typically, I tell investors not to do that, because at the end of the day, if you can make 15 to 25% or even 12% rate of return, it is a smart decision to technically generate that return from your investments rather than technically taking this money and paying off your mortgage. Now, if you cannot generate that kind of return, if you don't know other alternative, and if your capital sitting in your bank account idle, then it's not a bad idea to pay off your mortgage. Sridhar is asking a question again, that if you have $1 million in capital gains tax, is there a way that you can avoid paying taxes at once? Yes, you can. You can do two different strategies. There's a strategy called installment sale. You can do that, or you can also do the charitable remainder strategies or charitable strategies to avoid paying this capital gains tax. So my recommendation is, I would set up one-on-one meeting with our experts, send an email to info@perfecttax.com or sales team at perfecttax.com. Perfect Tax is with two T's, PERFECT, or you can text me at 214-454-7230. And I can maybe cover your scenario one-on-one and see if in your scenario if it is possible to do that or not. Now I'm going to go into next, continue the presentation. How do you value a real estate valuation method? This is very important for you to understand. Even if you invest with me or invest yourself, you need to understand that we are formulating all of these principles to maximize your rate of return. If you do not understand it, if you're just taking your rate of return as an asset, then you might not get the same income. Real estate valuation methods, there are multiple real estate valuation methods. It is valued at net operating income, which is called NOI. It is scheduled revenue minus vacancy minus expenses. There is another valuation method called capitalization rate, which is called cap rate. Cap rate is nothing else but technically, if this entire asset was paid in cash, in capital, in cash, what is the rate of return it generates for you? So if you paid, instead of leveraging from the bank, if you wrote a check, let's say for $500,000 for buying an asset or $100,000 for buying an asset, then that entire money is considered to be your capital. And if you're generating 10%, that is called a 10 cap asset. GRM stands for gross rent multiple. So it is multiple of your gross rent. Cash flow is 9, and net operating minus debt service. After tax cash flow is cash flow minus income tax on the revenue. Cash on cash return. You might hear this term a lot of times, that, what is my cash on cash return, which is cash flow over cash investment. Internal rate of return, IRR, is current value of the entire stream of income, includes final sale of property, so includes appreciation as well. So it includes the entire stream of income. It includes all streams of income, including income generating asset or income producing asset, and it also includes the capital gains towards the end. So evaluating the income stream, you're not just buying real estate, you're buying a stream of income to be received in the future. You need to remember, real estate is nothing else without, there are two kinds of benefit to real estate. One is your income stream, and one is appreciation. We call that capital gains. Actual rents or street rents. Street rents, through rent surveys in the area, you have to evaluate that. You also have to see actual rents collected for an asset after vacancy. So don't try to apply vacancy rate if you're looking at actual receipts. If you see that if the asset was 100% occupied, and that you have seen that year over year, don't try to apply a vacancy rate formula to that, because you have actual receipts which back those numbers and information. Vacancies. Apply a vacancy rate to street rates or pro forma rents. View over a year time. Your mileage may vary. Management can play a part here. Vacancy also affects other income such as laundry and vending income. So if you have high vacancy for an apartment or a multifamily or a hotel, then it could also affect your ancillary income like laundry and vending income as well. Vacancies also affect expenses such as utilities and unit cleaning and make ready. So it also affects expense as well. So vacancies are a very important aspect of calculating or performing your future investment. Also include collection losses due to non-repayment of rent. You have to also deduct the collection non-repayment of rent out of that. Quality of income stream. That is very, very important. Is it real? It is very simple to fake up the rent rolls. A lot of people out there do this kind of thing. So if you want to invest yourself, you got to be very careful. We have experts, and because of our tax expertise and the financial expertise, we are experts at evaluating the financial statements of any assets that we are acquiring, and we make sure that this is not artificially created fake rent rolls. It has happened. A lot of people have lost a lot of money doing that. So you got to be, careful about that. Is it steady or seasonal? How long have the tenants been there? What is the turnover? Are the tenants all related or all working for the same employer? How many tenants are behind on the rent right now? How many evictions have they had in the last year? Effect legal costs and fees may indicate poor tenant screening. How many units are non-revenue generating units? How much is it worth? There are multiple ways of approaching value. All are contributed to overall pricing. You can view it like a bond, which is cap rate, net operating over price. Lower cap rate means it's higher price. Cap rate is interest or yield on a bond. So higher cap rate means it's lower price. Viewing it like a stock. Gross rent multiple or price to annual income. So you can view an investment like a stock. Lower is better. So gross rent multiple, lower is better. So lower your rent you buy, that lower the rent is, better the asset is for you to buy. GRM is earning multiple. View it like a house. Price per unit, price per square feet. You can also look at that. If it is a vacant unit, you can find out that if you're buying a rental property, rental asset, you can say what is it price per unit or price per square feet, or if you were constructing it from ground up. View it like a business. You can view valuation like a business, cash on cash return and after tax cash on cash return. That's how businesses look at the asset. So what do I mean by view it like a bond? This is an intrinsic method of valuation. It does not consider financing. So looks at value as though there were no financing on the property at all. This is not affected by leverage. It doesn't consider taxation, doesn't consider appreciation in value. It is adaptable to any type of income property. Conservative approach, bankers use it, as do big all cash buyers like pension funds use this. View it like a stock. Stock is really a pretty weak analogy, but bear with us. It is gross rent multiplier is also like an earning multiple based on gross earnings. Doesn't consider financing or leverage or taxes. It considers appreciation to a small degree. As gross rent goes up, value also goes up. View it like a house. Comparable sales. Look for MLS listing. Some specialized registries like, Rodi report. Look at price per unit, price per square feet, comparable gross rent multiples, comparable cap rates, comparable cash on cash. View it like a business. What do I mean by view it like a business means? An asset. So before and after tax cash flow, consider financing. So you have to understand that if you were to invest $100,000 and out of $100,000, $30,000 was your own money and $70,000 was leveraged. So what that really means is if you were making $30,000, if you were making 10% return on your $30,000, you are making $3,000 a year on your $30,000. If the entire asset was making 10%, so 70% money which we have leveraged from the bank, we are also making 10%, so that is $7,000. But you are paying an interest cost of 4% today, which is $2,800. So you are technically making 7,000 minus 2,800, which brings you down to 4,200. So if you really take, you are making $4,200 on bank's money, and on your own money, you're making $3,000. if you were to combine that both of that capital, you are making 3,000 plus 4,200. You are making $7,200 on your money. If you divide 7,200 over $30,000 investment, then you have made 24% rate of return now. So leveraging could be very powerful. Leveraging could generate a 12 to 15 to 20% rate of return as well. It's very, very powerful. View it as an income property. It is a melding of all the methods above. It is an internal rate of return, considers everything. So that is also another simplistic view. We always ask, what's an internal rate of return? It allows you to assume percentage increase in revenues and expenses. It allows you to assume appreciation happening down the road. Also, you have to assume the income tax gains, capital gains, and recapture. Alternative investments, IRR allows you to assume a reinvestment rate of return on cash flows. The process of valuation, use house-like valuation to eliminate obvious clunkers. That is a simple formula. You are just looking at the market value and seeing what per square feet value is or construction cost is. So what next? Expanding your holdings. Can you use IRR methods to calculate your current IRR on existing investment? Yes, you can. So you should evaluate your existing investments from this perspective, what your IRR looks like. Look at the rate of return curve. Sell, trade, or refinance when the IRR drops below what you can get on the new deals. So this is very important. You sell, trade, or refinance when your IRR drops below what you can get on new deals. This method can work to help convince sellers that it is okay to sell. Refinance and pull cash out of the deal. This is the only place where GRK concepts really apply. And consider 1031 exchange rather than sales. Now we are going to talk about what some of the projects we have been working on and how we can help you generate that kind of return in a network group investment rather than investing yourself. Some of the sample pictures which you see are the rate of investments which we had initially done or are in process or are in progress. Why Texas? Our majority investment is all happening in Texas. Why Texas is attracting business investors? Texas is a strong oil-rich economy. It is a tax-free state. It is home state of 2 presidents of US, second largest state of US. It has relatively low real estate prices, lowest minimum wage rates, beneficial to business, steady warm weather, highest growth rate of economy amongst all states of US. Why Dallas is a preferred choice in Texas? It is headquarters of over 75 Fortune 500 companies. It has highest number of professionals, which includes physicians and IT professionals. It has lowest amount of unemployment rate in any state, even in COVID situation. And I've not forgotten the question about COVID. We are going to discuss after this last presentation about COVID and how we are avoiding COVID impact. Relatively low real estate prices, better and safer weather than other cities of Texas. It has higher per capita income, offering great market. It has 350 families move every day to Dallas Metroplex even today. Actually, number of families moving to Dallas have increased even more. So how do we secure better returns through cap rate strategy real estate business in US? Let me explain you what we do. Our strategy is to sell at cap rate. And how does cap rate selling works in US? Cap rate generates more than 20% of annual returns compared to average return of 5% in real estate investment in Dallas. Under cap rate, we do not sell real estate as a piece of real estate, but as a running business with steady income. We create profit-making business backed by real estate and sell them at business valuation based on earning capacity, or to be specific, at cap rates. How does cap rate selling work in US? Big insurance companies, mutual funds are looking for this fixed income stream. They buy this asset all day long. There are different types of cap rates for different class of real estate and types of business linked with those assets. Cap rates help to maximize sale price of underlying assets. So that is very important. Cap rates are normally sold for better quality rate of assets like Class A or Class B assets only. Our investment philosophy: we build value through land development, construction, tenant improvement, and leasing stabilization. Our goal is to focus on rapidly growing real estate development segment, and to better serve our investors, we have set up a separate division under the Perfect Group umbrella, namely Thakkar Developers, who constantly focuses on this thing and is constantly adopting a lot of in-house development activities to avoid paying expensive to external consultants, saving a lot of money to our investors. At exit, we may sell or refinance the project based on how best to maximize the rate of our investors. Investment strategy. We undertake projects or select high investor rate of investors that represent for selected high investors that represent exceptional return on investment while minimizing risk exposure. We use a blended strategy of pursuing income and growth to meet the goals of our investors. We focus our investments on project with 4 to 5 year timeline from acquisitions to exit. Today in the COVID situation, we are modeling this to be at a 6 years exit strategy because of the current COVID situation. Another thing is today we are focusing our investment philosophy is more focused. Somebody had asked me that aren't offices affected by COVID and because of work from home allowed by more and more employers. There are two schools of thought here that offices would still continue, but the office designs would change. Rather, not every business could be productive and generate the same benefit by staying and working from home. Some businesses could take advantage of that, and it's not incorrect. And some employees or some functions could take job role or functions could take advantage of that. So, to your answer, to some degree, yes, the overall need for office might go up, but also because of COVID situation happening, so many people are moving to Dallas that there is happening a talent pool drain in other cities and states. And more people are moving to Dallas, which ultimately is forcing corporates to open remote offices to Dallas area market space, which are offices where people can come in a shared work program where they few days a week, they are coming and working from office to collaborate and interact. And instead of having open space, now they need more cubicle and cabin space because of viral infections and those things. New buildings which we are designing keeping the HVAC systems like that in mind, which are COVID compliant HVAC systems, and at the same time touchless doors, touchless, restroom doors, touchless, elevators, app control elevators. We are using all of those functionalities to maximize this benefit. So if your asset is built current market, and if you keep this COVID situation in mind, you can design a more sought after building. And because of it depends on which market we are talking about. The market space like Dallas is always continuously appreciating because it is growing at the sake of other cities like San Francisco, Los Angeles, New York, and New Jersey, which are having a huge amount of, congested population, causing more challenge for these viral infections as well. These are the 3 projects. Actually, we had 4 projects in this cycle. Hotel was one of them. We have actually sold the hotel project, and we had anticipated the rate of return on the hotel project exit to be about 25% IRR. And today we have exited with about 25%, actually exceeding 25% IRR. And today we exited that project with 25% IRR in our fund. We are also in the process to exit another project in Irving. And our goal would be is that the fund which we floated in 2018, we would have 2 assets left. Eventually, by end of 2020, we would be exiting 1 asset, and by end of 2022, the 2 more assets which we are in the development phase will be exiting also. These are some of the pictures. This is the asset which we are talking about is in Irving, Plano, and Allen. There were 5 real estate transactions as part of this asset. 4 or 5 real estate transactions part of this asset. One asset was on southwest corner of 121 and Razor, where we owned a 36-acre land, and on that land we are doing the townhome development and the single-family home development of $40 million asset development, and we are doing another development which is the entertainment center, like a mixed-use entertainment center, which would have multiple uses of entertainment clubbed into one, including bowling, arcade, laser tag, movie theaters, into one single entertainment center rather than going to multiple places. It also had office building in Allen. Key attributes of this particular site was it was about 1.5 miles from Toyota's headquarters, and it was 25 minutes to Dallas Fort Worth International Airport. There are 57,000 cars and vehicles passed through this project. and project partners included JPI, TDI, Gensler, CBRE, and Avison Young. There is another project on Almine 121, which you originally started out. Everyone might have heard that in the news, which was originally planned to be a cricket stadium over there. We had planned for a concept of cricket stadium. One of the leading developer wanted to build a cricket stadium over there, but because of the recent market scenarios and the surrounding neighbors, the cricket stadium concept was dropped. Eventually, it was added with a multifamily. 1,600 units of multifamily was zoned in February of this year, where City of Allen rated us as one of the most socially aware developer, and City of Allen brought in this development over there, where they are bringing in $15 million of incentive in phase one in cash, which is on Almine 121. So what are the options to invest? Currently, we have floated a PG fixed income investment fund 4. This investment fund has a very unique characteristics in nature. It is investing in following kinds of asset. It invests into assets like opportunistic assets. It invests into mezzanine debt. It is also investing into income producing asset. It is also investing into rent generating asset backed by great tenant mix and income generating operating assets, which are again an opportunistic asset. The entire purpose of this fund is to generate income. And this fund is very interestingly designed. You start making income in this particular fund from the first quarter. You don't have to wait in this fund towards the end. Do you buy, there is one question I would like to take. Do you buy foreclosure distressed properties in your investments? So we are right now buying the distress. This particular fund is also going to look into an opportunistic and distressed asset. Depends on the kind of asset and what value we are getting from there. But again, goal is to generate income, and we generate income on this particular fund quarterly. So you get income from first quarter. I'm on W2. You can, there's one more question. I'm on W2. Yes, even if you're on W2, you should be able to get all of the benefits and tax strategies which we are talking about. The strategies are applicable to W2 as well. Ash, is it better to own a rental as a person or open a company and own it? I would strongly recommend to open a company and do it. And there are many reasons behind it, not only from the tax saving perspective, there are some tax saving benefits to it as well. But apart from that, there are also liability protection as well, Ash. So I would recommend again to set one-on-one free consultation where we can discuss and explain you in your scenario what makes more sense. I hope I was able to answer your question. Coming back to the presentation, this particular fund, PG4 fund 4, is a very interesting fund. As I told you, the way this fund works is you get a preferred rate of return in this fund, and you have 4 or 5 different classes of investment. We have first class of investment where anybody who invests up to 500K, you can invest $50,000 also in this fund, but up to 500K, you are guaranteed 8% per annum preferred return. It is paid every quarter. If somebody invested 500K to $1 million on this asset, they will technically be given a 10% per annum preferred return to be paid quarterly. If somebody was to decide to invest greater than $1 million, then the asset technically becomes a 12% per annum fixed return, again paid quarterly. And again, this fund, you can invest money from your 401k, IRA, or any of those accounts. Any assets this fund would invest, these returns are net of the fees. Any asset this fund invests money is mostly these kind of assets. That is opportunistic assets, investment in mezzanine debt, which is income generating asset, income producing asset, rent generating asset. Today we have a first tranche of this fund is, we are raising $10 million in next 30 days. And we already have commitment, we are raising $4.5 million in next 30 days. We already have commitment of $2 million today so far, and we'll be raising an additional $2.5 million in next 30 days. And this fund would attract the similar terms, 8%, 10%, or 12% fixed rate of return. We also have an option if somebody doesn't want a fixed rate of return, and rather they would take the returns more on the tail end, then the returns could vary from 15 to 25%. So you have an option, instead of technically making a fixed rate of return, a guaranteed rate of return, you can also go to, no, variable rate of return, where based on the performance of the underlying asset, you can make up to 15 to 25, but it is not guaranteed. But typically, that is a trend which we have seen. Our first asset in which we have was in Salina, and today the investors are exiting out that asset with 12% rate of return. The reason that rate of return was low was because it was a single family lots, and it was land only transaction and a remote transaction in Salina. That is what the asset performance was supposed to be expected, was about 8 to 10%, but today we are generating about 10 to 12% rate of return. So to summarize, do it now. How long do you plan to live? Plan it. Forget about everything you have learned in television or seminars. Develop a method that works for you. Then stick with it. This is business, not emotion. You're not looking to live here. So any of these assets you're looking is to cash the checks from others who live there. Remember, not every at bat is a home run. If you only swing at home run balls, you'll miss a lot of singles, doubles, and triples. So you got to keep swinging that. Thank you again, everyone, for joining. I'm going to actually put a poll on the screen right now. Actually, the poll is not working, so I would recommend that we would be sending this presentation to everyone on the email. And if you have any questions, please feel free to ask. Again, thank you everyone for attending. We have right now a very interesting fund which will be closing down in next 30 days, and that particular fund has a great return, 8%, 10%, or 12% fixed return, paid over period of quarterly payments. So you can consider that as an income, and it is guaranteed, so you get income every quarter. Again, thank you everyone for joining. I appreciate. I hope I was able to add some value and knowledge, and I look forward to meet with you again in next week's webinar. Next week's webinar is all about how you can technically save taxes by doing small things, even for a W-2 filer or an employee making 150K in income. And we will also cover some more investment strategies with Perfect Group of Companies and Tucker Developers. Again, till that point, you guys have stay safe. Have a phenomenal rest of the weekend, and I appreciate everyone joining. Thank you very much. And the next slide has a phone number on the slide and the email information. If you want to note that down, info@perfecttax.com or sales team at perfecttax.com, 469-213-1519, or you can also reach at 214-454-7230. Thank you everyone for joining this presentation on behalf of Perfect Group of Companies. I appreciate everyone joining. The PG rate of return, somebody's asked, the PG rate of return is 8% to 12% fixed rate of return if you want to get an income quarterly. If you don't want to get income quarterly, and if you don't want to get the guaranteed rate of return, the rate of return could be 15 to 25% rate of return. Depends on the performance of the underlying asset. There are two more questions I'm going to answer. What is the minimum investment for your investment opportunity? The minimum investment for investment opportunity typically is $50,000. And again, that could be done through any form of investment. You can do it through your 401k money, IRA money, retirement money. See, we have been in business for more than 20 years. So far, I tell people that as a family, we put our money in every project, and we are the first one to put in our money, and we are last one to take our money out. We want to make sure all our investors are paid before we take a penny of rate of return out. Only things that we charge are the fees through the performance and execution of the project, but all rate of returns on our investment comes after every investor is paid out. So that is our philosophy as an investment group. We again appreciate everyone joining. Thank you very much. Stay safe. Look forward to see you guys again next Saturday with a new topic on the seminar. Thank you again.